Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Welcome to another episode of Carolina Commercial Real Estate Connection. Today we have Randy Smith with us. Randy is with Impact Equity out of Phoenix, Arizona. Randy, thank you so much for joining us today.
Yeah, thanks so much for having me, Tony. I'm really excited to be here.
So Randy, if you could, I know we just did a quick synopsis. Could you give me a quick background on how you got into real estate and what you've been doing with your career prior?
Yeah, absolutely. So I am a corporate America sales guy. Spent 25 years in various sales and sales leadership roles, primarily across two main Fortune 200 companies over the last 22 years or so. And I actually started getting into active real estate investing as, you get to that point in your career where you're maxing out your 401k, you're doing your IRAs, and I started accumulating a little extra cash because I was doing very well in my sales role, and decided to start placing some of that capital into some single family rentals out of state. And we ended up doing out of state because here in Phoenix, the market was just on fire and you'd be upside down every single month. It'd be no cash flow whatsoever here in Phoenix. So decided to buy out of state, and I bought a couple of turnkeys in Kansas City. And then I found out very, very quickly that I wanted to be more involved with that process. So I ended up doing some Burr single family in Atlanta, and then COVID hit and it got really, really difficult to find properties. So I started investing passively in commercial real estate. And, fast forward a handful of years, and fortunately, when I got laid off from corporate America for the second time, I had created enough passive income where I didn't have to go back and chase another job. So went all in on the passive investing. And since then, I've been helping others kind of figure out the same path and helping other folks decrease their dependence on that W-2 in the event that their layoff comes. They have some options if that were to occur.
That's fantastic. So just to kind of touch back a little bit. So you have were in sales. What kind of stuff were you selling? What were you selling?
Yeah, so for the last 10 years or so, almost 11 years, I was working for a large credit card company.
Okay.
I'll just say, don't leave home without it, without mentioning any names.
Good.
And I was helping business owners integrate their payment tools into their accounts payable system. So it was B2B sales. I got to meet with a bunch of entrepreneurs and middle market, what we call middle market size companies. So folks with revenues under 300 million. So
Awesome. And then was COVID portion of the reason that you exited? Was that the timeline when you exited corporate America?
no, it was 2022 when I ended up leaving American Express, and it was actually COVID years were fantastic for
Okay.
the industry. We actually did very, very well during those years, just like a lot of the economy did. Of course, a lot got hurt, but no, it had nothing to do with COVID. This was more restructuring, reorganization.
I see.
Um, and
Okay.
when corporate America decides they're going another direction, they're going another
Right. Yeah.
direction. Yeah, whether you
It's
like it or
just,
not.
somebody way up top makes a decision and clop 30,000 people. There you
Exactly.
go. Right. All
Exactly.
right.
Yeah.
So let's back up a bit into the real estate. When did you start the single family out of state rentals? What was the timeline on that? How long ago was that?
Yeah. So I think that was 2018 when we bought that first single family. Now, of course, I sat on the sidelines for probably 3 years, maybe even 4 years, where I was thinking about getting into it. But finally pulled the trigger, I think, in 2018.
Yes. That is pretty typical than what I hear from people. A lot of people will, get interested and start educating themselves. Hopefully, people are listening to this, educating themselves, and it takes years to, really build up the courage sometimes to make the dive into something, right? Because you want to do it educated as possible, or if you want to do sooner, it's always something to consider is finding somebody that has that experience that you can leverage their experience to get in and you'll be a little more comfortable in the very beginning. So I think that's pretty standard though for looking for that long period of time. As you were saying, once you kind of max out your income and looking for other places to invest, it's a great opportunity to go in there and start to, give yourself some ability to lower your taxable income when you invest in real estate. So we love that idea. All right. So um, once you built up a few things you're saying with in 2022. So from 18 to 2022, we have 4-year timeline that you had kind of started diving in and getting into where at this point in 2022, you're saying you didn't even need to go back to a job. So can you establish how many properties did you build up during that time frame?
Yeah. Yeah. So I actually, let's see here, I bought two single family and a total of two in Kansas City and a total of four in Atlanta. But with the assets that we bought in Atlanta, we did the Burr strategy. So we were buying really ugly properties, like certainly the ugly house on the street, renovating them, putting renters in there. And we made all the mistakes that people make when they do these renovations. We had watched way too many HGTV shows, and we definitely we fixed these up much nicer than they needed to be for the class of tenants and for the areas that we were renting. But fortunately,
So you
um,
went from the worst house on the block to the best house on the block.
pretty much, yeah, pretty much. And yeah, it's exciting. We had a lot of fun doing it and all of that. But no, when I look back at it, we could have spent much less on the rehabs and probably got the same results. But um, fortunately, though, the market was just exploding in Atlanta when we did it. So, one house as an example, we bought a house for like 50 grand and we put 50 into it. And I think we sold the thing for 220, 230 grand, call it a year and a day later. A little bit more than a year. So we were just in the short-term capital gains. But we did that a handful of times and created quite a bit of capital. And then we sold all of those houses and we shifted everything into passive income. I think by the time I got laid off, I was invested in either 12 or 15 passive investing deals. And we had been, oh, what do I say? So we were Dave Ramsey folks up to that point. So we had a very small monthly number we needed to hit because we had paid off literally everything at that point. So now I share that the income we had covered the majority of our expenses, but it didn't replace my income by any means because I was making very, very good money. But it gave us the cushion to give us options that we wouldn't have had without those extra dollars coming in. So,
So, okay, so let's dive in on that a little bit. So you went from you got you with the Burr, you flipped out, you created a bunch of um, wealth that you had generated from the Burrs in Atlanta.
yep.
Did you still hold on to the um, pieces in Kansas during this,
We ended up
or
selling
did you
all
flip
of
out of them?
yep, we sold everything.
Okay,
So,
so you were flipping through everything and just basically building up a pile of cash. With the pile of cash that you'd built up over the few years, you started doing passive investing. You said 12 to 15 deals. For people that don't understand, could you kind of give me an idea? What were you investing in? How did you invest in that? What brought you to that? Could you give somebody who has no idea about what a passive investment looks like, what they should be looking for and what you looked for?
yeah, yeah, absolutely. So that question could be probably 8 different podcast episodes in and of itself. But yeah,
But just on a high level.
yeah, yeah, of course. So, at a very high level, ultimately, when I was doing all these single families, I found out pretty quickly I wasn't going to be able to scale that to the amount that I wanted. And my time was better spent focusing on my job because I was making very good money in the job. So, and to top it off, like the market had just blown up and I wasn't able to find the type of deals that I was finding just a couple of years prior. Okay. So I had been listening to a ton of podcasts, reading a bunch of books, and came across this idea of syndication, which was really, really appealing to me because what I found out during that burst process was that I was not a flipper. I was not a project manager or a property manager. I very much my kind of superpower is sales and working and communication and those types of things. So I found out very quickly that that probably wasn't something that I was going to scale to the level that I would need it to scale to really decrease my dependence on my W-2. So I started looking at the syndication model. It was really appealing to me because you're taking your own dollars and then you're investing in an operator that has an established business, that has expertise, that has credibility and has a track record. And quite honestly, they're going to be much better stewards with my money than I will be if I go out there and try to be a weekend warrior doing the HGTV flip that I had no business doing in the first place. So by spending my time and energy finding and vetting the best operators and ultimately the best places to invest my money, I found that I could actually increase my wealth much quicker because they're much better at doing that than I am. And so it really comes down to, finding asset classes that one, you have some interest and excitement about, and two, you have a network where you can start finding the biggest and the best operators out there. So when you place your capital with them, you feel confidence that your dollars are going to come back with some friends, as a buddy of mine likes to say. Put the dollars out there and watch them come back with some friends. So that's kind of the path.
Yeah, that sounds fantastic. So for someone that hasn't done this, you go out, syndication is a lot larger now than it was a decade ago. So there are a lot
Yep.
more operators out there. So, if you determine an asset class you like, and maybe you want to learn more about it, and you're not comfortable investing completely on your own, or you feel that, it's a much higher risk with you investing on your own, you can find someone that has a track record like Randy that's been doing it for multiple years, that has built up connections to people. Even if it's not him, he's built up connections to people that are doing this for years and years and years, that have a track record of going through full cycle on projects, and have can show you the profit that they've received, which gives you more comfort when you're going in and investing. They have access to a lot more deal flow than someone like you or me when you just go out, because they have a track record and they are carrying multiple millions of dollars of property already. So people are reaching out to them with all the good opportunities. And these are much larger opportunities than you could ever obtain on your own or with a friend doing something like that. So those
Yep.
are kind of a quick synopsis of why you look at this. And so when you got into it, let's kind of understand, you're saying you jumped on 12 to 15 passive investing deals. What did you look for? How did you vet those? And what made you comfortable to get involved in the beginning?
Yeah, yeah, and great question. And I think that's the $1 million question if you're getting into this space is how do you find and vet operators? And what I'll share with you is I made some mistakes early on. Um, and I ended up, well, I made some mistakes, but fortunately they're done very well. But I think it's very important for investors to know what it is that they're trying to achieve when they come into this. And I remember hearing that when I first came in, and I thought it was silly because it was, I thought I'm investing, I just want the dollars to grow. And as you dig in and you learn more, you find out that, there's cash flow investing and there's wealth generation or wealth growth opportunities that are going to grow the capital faster. And I didn't really know. I just knew I was making good money as a sales guy and I wanted these investments to grow. That was literally it. I thought at the time that I was a growth investor because I would always have this great job that I would never need cash flow. And I always heard people talking about cash flow, cash flow, cash flow. And I thought, well, that's silly. I'm making all of this money. I don't need any more cash flow right now. But then when you get laid off, all of a sudden you shift from being a growth investor to a cash flow investor because you need that monthly income. So with that being said, when I first started, I started looking at, ultimately the only places where I saw deals, which were listening to podcasts and listening to people at local meetups when and if I was able to get out to those. So I saw some very large brands that had established companies that had been doing this for years, and they had podcasts, and they were very, very large brands in the marketplace that over the years I began to trust those folks just simply because I was listening to their podcast, had been educated by them for a handful of years. And then I would meet these smaller guys at these meetups who were essentially trying to do the same thing, but they had no track record whatsoever. So I ended up pulling some money out of an IRA that I had shifted an old 401k into. And I took those dollars and I invested. I actually invested like $110,000 in my first passive deal with one operator that had a fund, and he was buying 10 to 12 mobile home parks across the East Coast, and I heard somebody call it the smile, the United States smile, basically, the Sun Belt. So placed some capital there, and then my second deal, I placed it with a large multifamily operator that had a fund as well. And then from there, I found a local group that was buying very, very heavily here in the Phoenix market. So that was kind of my initial process. Was I just placed my dollars with people that I knew and that I had started to trust because I was listening to their podcast. And as I became more experienced with it, I learned more and more how to vet those operators.
Those are definitely three. So the one in Arizona, what type of assets were they investing in?
Multifamily, multifamily.
Multifamily.
Yep.
So you had a large multifamily operator, a small multifamily operator, and a mobile home park operator were your three that we're looking at, right? If we're
Yep.
running this quickly. So the first one that you invested in, what drew you to them, and how did that one, could you walk us through that one, how it looked, and how did it pan out?
Yeah, yeah. And I think the biggest reason that I invested with that one is that I've been listening to the guy's podcast for like 4 years. And I felt like I knew him. He had been a big part of the education process for me. And my thought, because I had actually I had spent a lot of years in very large organizations. So I liked the idea of well-established companies with large brands and the infrastructure in place to manage this huge business, because these are very large businesses. When you're talking about renovating hundreds of units or buying, tens of thousands of mobile home units as well. So I ultimately vetted that one just by meeting folks in the online communities and talking to them about their experience with them, with this specific operator. And then ultimately I called them and had a handful of conversations and made
And
the
these were
decision.
were those current investors in his deals?
They were, yes.
Oh, great. So your vetting process was you had listened to the podcast, obviously, so you felt like you knew him to a certain extent. Then you found and reached out. How did you find the people that were investing and reach out and able to connect with them?
Yeah, so just to be transparent, the name of the organization was it was Brandon Turner's group, and I
Oh,
had been
okay.
listening to Bigger Pockets, and they have a big online forum, or Bigger Pockets at the time, not Open Door Capital, but Bigger Pockets, and I was able to find a bunch of folks that had invested through them just through that community.
Awesome. Yeah.
Yeah,
Now they're definitely one of the bigger established brands, right?
yeah, no doubt, no
So
doubt.
yeah. So I
And
think
he's just an overall good guy. He seems like a guy that you could trust, and I felt very confident that, and kind of the mindset there is like, if it's a large, well-established brand, I thought it was highly unlikely that they could well, not do well and not return capital. I know today that that's not necessarily the truth, just because they're a large organization, because the market is very, very different today, and we've seen some of those big guys fall. Fortunately, all of the investments I've made up to this point, I've not had any negative experiences other than some positive distributions at this point. So
well, that's great. So you vetted and you got to speak to some of the people. And what were some of the questions that you asked? What did you feel like you figured out that was, that you look back now that was important? What do you wish you would have asked maybe that you didn't? Could you kind
yeah,
of dive into that a little further for someone that hasn't ever done it, that would kind of give them a little kind of a time track record of what they should maybe ask for, what you
yeah.
didn't?
Yeah, I think probably the most important questions on the front end are track record. And, you know, what I found with the folks that I was investing with earlier is sometimes those groups did have track record, but more often than not, they were partnering with groups or individuals that had quite a bit of track record. Like yourself, you're in the construction space, you've got years and years and years and years and years of construction. I know when and if I invest with your group that construction's going to be handled. Like I don't have any doubt about that because of your expertise. Um, this particular, my first investment, he partnered with somebody who was like the ultimate expert in the space where they were working. So, you know, Brandon Turner, very large public figure, didn't have the experience in the mobile home park community, but he partnered with somebody who had that experience. So they brought their superpowers together, and that was what allowed them to grow as fast as they did. Now, what I didn't know to ask early on, and one of the early mistakes that I made is and this is just simply, I didn't do the research that I should have done, is that I thought that the average cash on cash was going to be my cash flow throughout the hold. And you found out very quickly that um, average annual return, average cash on cash, IRR, all those metrics are very, very important, which ties back to my initial point that you've got to know what it is that you're trying to achieve so that you go out and find the operators and the asset classes and the business models that give those types of results. So if I was depending on that monthly or quarterly cash flow to support the household, then I should have gone out and found something that was doing very consistent cash on cash returns right out of the gates. So that was probably one mistake. Secondary, I invested initially in a fund, which meant he was going to go out and buy a bunch of different mobile home parks. And I think it's fantastic from a diversification standpoint. But if your goal is to grow your capital faster, I find personally that single asset investments give you the ability to do that faster because more often than not in a fund, they have to sell all those assets on they have to buy all those assets, they have to execute their business plan, and then three, they need to sell them all before you get your big payoff at the end. If they're just buying one asset, it increases the likelihood that they can do that quicker uh, compared to having to do that 5 or 10 or 12 different times. So that was one of the big mistakes. And one of the other mistakes that I made early on is I invested more than the minimum on that first investment. And in hindsight, what I do today is I usually ask to do half of the minimum on the first investment. And then as I get to know the operator more, I'll go back and invest in additional deals with them. So instead of putting 100 and some odd $1,000 with them, I would have preferred to have done maybe 50,000 across a couple of deals or 25 grand across 4 deals just to decrease my risk and increase my diversification across multiple asset classes and multiple opportunities and multiple geographies and potentially even business plans as well. So that's a lot there.
That's very interesting, Randy. I've never,
Yeah.
so typically, I didn't even know that was something you could do. So that's news to me. So you're saying that if they had a minimum investment, let's say a 50K, so you would say, okay, first time investment, I'm not going to give you 50K, I'll give you 25K. And, you know, one thing that you brought up that I think I'd love to talk about is, the difference in the fund model to the single investment model. So it's just like, putting your money in a mutual fund or putting your money in an individual stock in essence, right? So
Yep.
putting money in a mutual fund, you're tied to a bunch of different items, and then you're more tolerated for ups and downs, but you're also not going to get a really substantial return. So if you are willing to risk a little more, then your return can obviously be higher, and you can move. And so understanding that this is an investment and there's no guarantees either way, it's more of a comfort level, right? At establishing and understanding that. And then something else that you brought up that we want to touch on is, you went in, they project. So when someone's giving you, a layout of what they're showing you they're going to think it's going to return. You were looking at the cash on cash and saying, oh, okay, wow, here's the cash on cash. This is going to give me this much money every month for this that I invest. And so what you need to understand, if there's someone's going in and they're doing a renovation or a repair on the property, the cash flow is not coming in while they're renovating and repairing the property. So that is a blend of what they think the full timeline that they're giving you, you're going to get as a return. So you might get no returns if the renovations take a year prior
Yep.
to getting your first return, but then over the 5-year period that they're saying the investment is, it's going to go back and average you the return that they're saying. That's what they're projecting, not guaranteeing. But
Yep.
understanding that if you are in a position and then you get laid off or, quit your job and you've got a couple of these and you don't understand that, then you might have no money coming in, right?
Exactly.
And you're
Yeah.
going to call an operator and they're going to be like, well, I didn't tell you when the money was good. That's just an average. So yeah, those are
Yeah.
great points for somebody that's not versed in looking at these things that they need to understand. So those were very important points. That's why I kind of wanted to reiterate them. So something else. So let's go back to the fund model. So for people that don't have a full understanding of a fund model and what that all entails, could you kind of go in a little deeper on that and so they can understand?
Yeah. Yeah. So that it's let's see here. So there's a bunch of different structures that are used in these models. You've got, the most simple type of model that exists is a joint venture where a handful of guys come together and they decide to go buy something. It's the same basic principle of syndication, but it's at the smallest level, I guess. So as you move into syndication, the operator has the ability of buying bigger and bigger assets because they're using other people's money in order to do that. And from that point, generally what will happen is the syndicator will find an asset and then they'll get it under contract and then they'll go out and they'll raise the money and then they'll close on the asset. And it works perfectly if they have the ability to raise capital quickly. The challenge that comes up, and especially in this market, is that it's become more and more difficult to raise capital. So operators have started leveraging this fund model where they go out to the market and to their investors and they say, these are the type of investments that we're going to be buying. We may or may not have found an asset or two or three, but our goal is to buy 8 or 10 or 12 over the next 12 months. And you can get involved in those deals right now by investing today. So what they do is they raise a bunch of capital, which makes it much, much easier for them to go out and then close on assets much quicker because they're not waiting to raise the capital on the back end. And it's very, very beneficial to them because it gives them some more clout when they go and make offers on specific assets because the people they're buying from know that they don't have to go out and raise the capital because they've already got it. Okay. So lots of benefits for them. For me, the challenge has always been with funds is that I don't know the specific assets that they're buying. And the only due diligence I can do is on the operator. I can't do any due diligence on the asset. I can't go drive the properties. I can't talk to the property managers and, get to know those assets before I invest. So there's good and bad in those models. To the passive investor, there's benefit in that, yes, they're getting diversification across a bunch of different assets. But again, they're losing because, and not necessarily losing, but it's because it depends on the preference of the investor. So that's kind of a different model. Now, something else we're starting to see, and something that I actually got involved with after finally leaving my W-2, is I am a fund manager where I partner with operators that their expertise is executing these business models, and my expertise is educating and communicating my investors. So I go out and find the best operators and I find the best deals from those operators and make the decision to bring investor capital to some of those deals through my fund. So my investors invest with me, and then I turn around and immediately invest those dollars into a already identified asset. And our fund investors get better returns because we're bringing a bigger check to the table than what the traditional investor brings. So those are just a few models. There's also a blind fund. I'm hearing a lot about customizable funds lately as well. But those are kind of the main structures that an investor is going to run into if they're out there looking to place capital today.
Yeah, that is definitely a good quick overview and synopsis. So now let's dig in a bit on your model, on what you're doing for people to understand that, because I find it interesting and I feel like it adds an extra layer of protection for someone, especially if you're newer. So just to break down a little bit more what you're doing. So you can do what we just talked about. You go out, you look, you vet these operators, you get understanding, see what they have for history, and then choose, maybe I invest in their deal. So when you're investing in them, you're doing all your due diligence. You're searching around for operators. You say, okay, this operator is someone I trust, like you did initially, and then say,
Yep.
okay, let me invest in them. Right. So you're the person that is saying, okay, I'm the expert. I'm going to find these people. I'm going to take a checklist that someone else gave me, and this is the operator I'm going to choose based on the questions I ask and my comfort level. That's what we discussed, and that's what you did initially. Then to break it a little further, what you're now doing is you're focusing all your time on speaking to operator after operator after operator after operator, looking
Yeah.
at this operator's work, what they've done, what are their returns, what's their track record, what's their history, and this is what you're spending every day, all day doing, speaking to all these people. Through that, you're building up, okay, this person has the great track record for this. This person has a great track record for this. So you are building more and more and more connections than most anybody just doing that. So you can then have investors come to you and they say, what are their investment criteria? You're able to then say, okay, based on your investment criteria, this is what we would try and invest in. And I have such and such operators, and they would give you this type of return. I've negotiated probably a little bit better structure than you would be able to do because I have more money that I can put into the deal cumulatively with all of my investors. Is that right?
That is it exactly. Yes, you just summarized my entire world in my life right now. And I would love to say that I'm working full time, 40 hours a week, but it's probably more like 70 hours a week. Oddly enough, I'm working more now that I don't have a job than I ever have in my life, but it's a ton of fun. So yeah, basically I'm spending a lot of time getting to know these operators in much more detail and much more depth than I ever have before. I'm getting to go drive properties. I'm getting to sit on asset management calls. I'm like truly understanding the underwriting models and the asset management plans and getting to know these guys. And it is very much a full-time job. And if you're placing capital into these deals, I think if you're going to do 50 or 100 grand or 3 or 4 deals, I think it makes sense to read the books and the podcast and get to know some people locally. But if your plan is to place a large amount of capital, it makes more and more sense to become more and more involved in those deals. And we call it passive investing, but it's anything bust. But unless you're just working your W-2 and you want to place some capital. So if folks are interested in getting into this space, I caution them from jumping in and throwing a bunch of money at deals before they really get to know folks, or before they get to know somebody like me that can really help guide them through that process. Because there's a lot of players out there, and not everybody. I don't think anybody approaches things with negative intent, but I think there's a lot of people that go to conferences and they sign up for their 3-day weekend event and pay for their $30,000 guru, and they think that they can start raising capital and syndicating. But this is a very difficult business with very large businesses behind them. So it pays to do the due diligence and invest in the right operators for sure.
Yeah, I mean, there is no guarantees in this. So we've seen a lot over the past few years. And of course, this gets attractive. This was attractive back in 06, 07. When you watched, everybody was making bukus of money. Here, everybody made tons of money over the past 4 years, right? It's just exploded, and it has a lot to do with the inflation and real estate being a great inflation hedge. To And I don't foresee there being some massive crash just because of the devaluation of the dollar over all this
Yep.
time. But,
Yeah.
where do we look at on a growth perspective from here? So you have to, right now is not just, you can't just do it like it was in a few years past where you just throw money and everybody's making money and everybody looks like a genius. Right now, it's critical, but you have the stock market that's very unstable. We don't know where that's going. So there's a
Yeah.
lot of instability throughout with any investment right now. So finding someone like you that is spending day in and day out looking at these things should make you a little more comfortable than you doing it yourself and give you a little more options. But I do think it's important to understand a couple things. So when you talk to someone, Randy, so if someone's calling you and they're looking and saying, let me vet you as far as let me see if what you're legit and how I would invest. What is it? So if someone's coming to you, do you only deal with accredited investors?
No, I deal with both non-accredited and accredited investors,
Okay.
um, which brings up a whole different slew of questions that can occur there. But I can only work with folks that I have what is called a pre-existing and substantive relationship. And unfortunately, that that definition is not clearly defined by the SEC. So it seems like if you line up 10 different SEC attorneys, you'll get like 12 different answers on what pre-existing
Right.
and substantive relationship is. But yes, you need to have that relationship, and it's important that there's an established policy that the operators are following. And ultimately, what ends up happening is people are getting so desperate for money, is they start to get very lenient with what they call a pre-existing and substantive relationship. So, all that to be said, if you're investing with somebody, make sure that you've had, multiple conversations over, 30 days plus. Maybe you've met with them in person or on Zoom a few different times, and that you've got to know them as an operator as well. And then there's also a requirement on the non-accredited investors that they be considered sophisticated. And again, it's a very broad and general definition that you'll get many, many different answers. But at the end of the day, these sophisticated non-accredited investors need to know that these are illiquid investments. You can't invest the dollars and then call back in 30 days or even 2 or 3 or 5 years and ask for your money back. And it is possible. And you've said it a few different times here. These are risky investments, and it is possible for you to lose all of your capital on these. It's unlikely if you do the right due diligence, but it is always a possibility. And we're seeing a lot of people lose money now because they didn't vet the operators as they should have on the front end. So yes, I work with both accredited and non-accredited, and I spend quite a bit of time getting to know and educate my investors before. And I feel silly kind of saying it, but before I'll allow them to invest in our deals, because I just you never want to take anybody's last $25,000, and you never want to put somebody in a situation that's going to hurt them financially if things go things don't go as planned. So
That's a great point. I think it's important to always bring up, you what you don't want is somebody that's just going to take your money. Uh, we're not nobody's out here just looking to take someone's money. You have to understand what you're investing in. You have to understand the risks. You have to be comfortable with those risks. You have to understand the structure of how you're going to get money. If you get in a bind, you don't want to push so much of your investment capital that if you get laid off or don't have income coming in, that you then need to call and try and pull that money out, because odds are you're not going to be able to get that money back out when you need it most.
yeah,
So you have to make sure this is an investment that you're locking up money, sometimes 3, 5 years. There will be multiple exit plans presented if you're in an investment, an individual investment, as we discussed. But those are just, pro formas, what they're thinking. So they're giving themselves multiple exits. They're thinking, so they might say, okay, the plan is to exit out of this in 3 years. But all that is dependent upon consistent market conditions. And market conditions, as we've seen recently, shift and go every which way under the
yeah,
sun. And you have an election year coming up. So there's a shift. So when you invest in something right now, everything can go one way or another way, maybe just depending on an election that has nothing to do with anything that the operator would say, the investment itself, anything, but it's just things that happen. Things do happen. So you have to understand that this is an investment. It has inherent risk with it. And there is no guarantee you get your money. There's no timeline guarantee on anything. Everything is an investment. But, the more risky the investment, just like with a penny stock, for instance, then the higher the reward typically. So it just depends on your stomach for it. And the nice thing about real estate as opposed to stocks is it's tangible. It's going to be there. Typically, the only way you're going to completely lose your money is if the operator really messes up and has to hand the asset back to the bank or something. That's really the worst case scenario, but it's not as easy to lose. And somebody has control to be able to try and save that investment, as opposed to a stock where you have zero influence on what's going on. With the real estate, your operator has the ability to work and manipulate that situation as much as possible to try and save your investment. That to me is the biggest difference when you're looking at investing in something tangible or investing in a stock, right?
Yep.
Any other thoughts you would have on that, Randy?
Yeah, we just say real estate investing or real estate as a whole is very, very forgiving. And if you hold any asset long enough, the value is going to go up. So as you mentioned, the operators, where people get in trouble is if the operators make really, really, really big mistakes. And what we're seeing today is those really, really big mistakes are bad loans. And if you're forced to sell when the market is down, that's when people are going to get hurt. So last piece of advice to folks is make sure that they understand the type of loans that their operators are using on their investments, because that loan is really, it's the single most important thing in this space that we're finding out today, because if you have to sell when the market's down, that's when investors lose money. So.
Well, Randy, I sincerely appreciate you coming on today. I feel like we have really got to dive into quite a bit, and it's been very impressive. I'm impressed with, what you've put together and what you've done. It's definitely different from anybody we've spoken to thus far. Very interesting. If people want to reach out to find out more about what you're doing, some opportunities that you may have available, what's the best way to get in touch with you?
Yeah, probably the best way is just simply going to my website. I have my scheduling link right on the website. The website's impactequity.net. If you want me to respond right away, I spend the majority of my day looking at my LinkedIn page. So you can always message me there, but I'm always available if anybody wants to chat. And there's no high pressure sales or anything here. I just love talking about this stuff. It's changed my family's life. And it's really given us the options, the freedoms that we never got in corporate America. So yeah, definitely reach out. Oh, and I've got a podcast as well. It's called The General Art of Crushing It. And we focus on helping to educate and inspire the newer passive investor. So yeah.
Awesome. We'll put that in the show notes along with Randy's contact info. Please reach out to Randy. Great guy. And I think, gives you plenty of opportunities. If you do not have a lot of experience in investing or experience in real estate, he's definitely someone to talk to. So Randy, thanks again so much for joining us. We appreciate it, sir.
Thanks so much, Tony. This has been a lot of fun.
Have a great day, man.
You too.